Picture this scenario for a moment. You open your investment account one morning expecting to see the usual modest gains, maybe a few $100s here and there. Instead, you discover something that stops you cold. Your money has earned more while you slept than many people make working an entire week at their jobs. This isn't some fantasy or get-rich-quick scheme. This is the predictable outcome of understanding how wealth actually builds over time. Most people approach money building like climbing a ladder, assuming each rung represents equal progress toward their financial goals. Save $10,000, you're 10,000 closer to your target. Save 50,000, you're 50,000 closer. This linear thinking feels logical, but it completely misses how money actually multiplies when you give it time to work. My name is Jim, and I help people understand money, personal finance, and how to actually build wealth over time. If you're serious about getting your finances on track, and maybe even getting ahead of the pack, make sure to subscribe to the channel and hit the like button if any of this helps you out. It's free for you, but it tells YouTube this is the kind of content more people should see. The reality of wealth building is far different and infinitely more encouraging. It doesn't move in a straight line. Wealth building resembles pushing a massive stone up a steep incline. The beginning requires tremendous effort with seemingly little progress. You strain and sweat, watching that boulder inch forward painfully slowly. But here's what changes everything. Once you reach the summit and that boulder tips over the edge, gravity takes control. What once required your constant pushing now builds unstoppable momentum. There are 3 specific moments in your wealth-building journey where this transformation becomes undeniably real. These aren't arbitrary numbers plucked from motivational speeches. They're points where your money stops being just savings and becomes a wealth-generating machine working around the clock on your behalf. The first breakthrough happens when you reach $100,000. The second occurs around $650,000. The third milestone completely reshapes your relationship with money and financial security at $1 million. But here's the part that surprises almost everyone. Reaching that first 100,000 doesn't put you just 10% of the way toward becoming a millionaire. You're actually much further along than basic arithmetic suggests. This misunderstanding explains why countless people abandon their investment plans just before the magic starts happening. They look at their account balance after years of consistent contributions, see what feels like glacial progress, and conclude the whole system is rigged against regular people. They couldn't be more wrong. Money. Stat 1. The first 100K. Let me show you how this works with real, simple numbers that can change how you think about time and money. Imagine you commit to investing $500 every month. That breaks down to roughly $125 per week. For most working adults, this represents the cost of dining out a few times, subscription services, coffee shop visits, and those small impulse purchases that seem harmless individually but add up quickly. Now, assume your investments earn a reasonable long-term return, something in that single-digit range people often quote for broad stock market growth over decades. Nothing crazy, nothing exotic. Here's what usually shocks people. It takes the better part of a decade of steady investing for many people to see that first $100,000 in their account. In those early years, most of your account growth comes directly from your own contributions. You're essentially doing the heavy lifting while compound growth is still warming up. By the time you hit that first 100,000, a big chunk of it is money you put in yourself, but a surprisingly large slice is already growth on top of your contributions. Roughly speaking, you're looking at something close to a half-and-half split between what you saved and what your money earned for you. This is where most people make a critical error in judgment. They examine those numbers and think, all that work, all those years, and I'm only here? This is too slow. What they don't realize is that they've just completed the most challenging phase of their entire wealth-building journey. They've built the foundation that will support everything that follows. Think about learning any complex skill. The beginning always feels frustrating because progress seems painfully slow. But once you reach a certain level of competency, improvement accelerates dramatically. You've just reached that tipping point with your money. Remember, your goal might be $1 million, and you've now hit 100,000. On paper, that looks like 10%. But in wealth-building terms, you're much further along than that, because from this point forward, your money starts working harder than you do. From here, the next major milestone is $200,000, and this is where people's minds start to change. That first 100,000 felt like it took forever. The next 100,000 usually comes noticeably faster. Instead of feeling like another long, painful slog, it arrives in just a handful of years of doing the exact same thing you were already doing. At this point, you might be a bit over a decade into your investing journey and sitting at around $200,000. And the math has quietly tilted in your favor. A much larger portion of that money is now growth rather than your own contributions. You're still adding $500 a month, but the snowball is finally big enough that the hill is helping you. As you keep going, that gap widens. The next stage is where the numbers get really interesting. Somewhere well past the 10-year mark and edging toward 2 decades of steady investing, you might see your investments climbing into the $400,000 range. Yet, when you add up everything you personally contributed over that entire stretch, it's still only a fraction of your total balance. The majority is now pure growth. Think about what that means. A portfolio in that range can easily be earning tens of thousands of dollars per year just from market returns in a normal year. That's more than a lot of people are able to save out of their paychecks, and your money is doing it automatically while you live your life. And that's all off the back of a decision to take a few $100s each month and put it to work instead of letting it disappear into lifestyle upgrades and short-term comforts. Money Stat 2, the power of around $650K. Now let's talk about the second major tipping point, roughly $650,000 in productive assets. For context, think about the typical household income. In many developed countries, the median household income isn't some huge number. It's a modest middle-class salary. People trade their time, their energy, and often their health for that paycheck. Now imagine instead that you have about $650,000 invested in a reasonably diversified portfolio. At that scale, a single-digit percentage return, let's say something in the range of 8% in a decent year, can generate on the order of $50,000 in investment income by itself. To be clear, these are example numbers, not guarantees. Markets move up and down, returns vary wildly from year to year, and nothing is perfectly smooth. But we're talking ballpark math here, and the ballpark is what matters for how you feel about money. That level of portfolio changes your psychology. Suddenly, your investments can realistically cover a significant portion of your annual expenses. Maybe they cover your housing and groceries. Maybe they cover your entire basic lifestyle if you live simply. Either way, the emotional shift is enormous. This is usually the moment where people realize, wait, losing my job wouldn't instantly ruin me. I have time. I have options. That's the real power of this money stat. You're no longer living and dying by the next paycheck. A bad boss is an inconvenience, not a life sentence. An unexpected bill is annoying, not catastrophic. You can keep working and let your salary accelerate your investments, or you can start rearranging your life in ways that actually match your values. Maybe that means working fewer hours. Maybe it means moving to a cheaper area. Maybe it means finally taking a risk on a business or a career change you've wanted for years. And there's another layer here a lot of people miss. If your investments are earning, say, 8 or 9% in a decent year, and you're only withdrawing 6 or 7% to live on, the remaining growth helps your portfolio roughly keep pace with inflation and even grow your purchasing power over time. Your capital isn't just surviving, it's very slowly getting stronger in the background. Then, of course, there are things like Social Security or pensions, depending on where you live. I wouldn't build a plan that relies 100% on them, but even a modest check layered on top of investment income can turn comfortable into very comfortable. This is the point on the journey where money stops feeling like a constant threat and starts feeling like a tool. Not a flex, not a scoreboard, but a seatbelt and an airbag for your life. Money Stat 3, the $1 million threshold. Now let's talk about the number everyone fixates on, $1 million. Your first million doesn't just represent a bigger version of what you had at $650,000. It represents a complete mental shift. Most people who reach this point didn't get there by chance. They got there through decades of boring, consistent behavior, saving, investing, avoiding catastrophic mistakes, and letting time do its thing. If you stick with that simple $500 per month plan and you stay invested through the normal ups and downs of the market, reaching 7 figures is often just a matter of staying in the game for a few decades, not finding some secret trick. By the time you hit that number, something changes inside you. You realize This is real. This isn't just theory anymore. All those years of driving the older car, cooking at home, and saying no to status purchases finally have a visible payoff. Do you suddenly feel rich? Probably not. Inflation has chipped away at what $1 million can do, and in many big cities, it's nowhere near private jet money. But you do feel secure in a way most people never will. If that million is invested reasonably well, it can throw off tens of thousands of dollars per year in passive income. Combined with even a modest Social Security or pension check, it becomes very hard to imagine a scenario where you're completely wiped out. Here's where the math gets fun. Once you have that first million, you no longer need miracle returns or giant contributions to see big jumps. A 50% increase takes you from 1 million to 1.5 million. Doubling from 1 to 2 million is just one more 100% growth cycle, which the markets have historically delivered multiple times over multi-decade periods. Going from 2 to 3 million is another 50% jump. From 3 to 4 is roughly a third. In other words, each incremental million often comes faster than the last, as long as you stay invested and don't blow up your plan. That's why so many comments from people further along sound similar. They talk about how the numbers suddenly started moving in big chunks, not tiny steps. At this stage, wealthy people start viewing every financial decision through a different lens. They know every dollar they spend today is a multiple of that dollar they're giving up in the future. That doesn't mean they never spend money or enjoy life. It just means they're fully aware of the trade-offs. And yes, market crashes still happen. They always have and always will. But when you've been investing for 20 or 30 years, you learn a different lesson about those crashes. When you're in the accumulation phase, downturns are an opportunity. Your $500 per month buys more shares when prices fall. When markets recover, those cheap shares do a lot of heavy lifting. When you're in the withdrawal phase, the key is having a sensible plan, keeping some cash or safer assets to cover a few years of expenses, so you're not forced to sell at the bottom. The point is not that markets move in a straight line. They don't. The point is that over long periods, staying in the game has historically been heavily rewarded, especially for people who aren't constantly jumping in and out based on fear. Closing. So those are the 3 net worth milestones that change everything. Money. Stat 1, around $100,000, where your money finally starts to pull real weight alongside your contributions. Money stat 2, around $650,000, where meaningful passive income starts to give you real choices. Money. Stat 3, $1 million, where you realize you've basically won a financial game most people don't even know they're playing. The mathematics doesn't lie. Building wealth takes time, patience, and consistency, not perfection. 20 or 30 years from now, that time will have passed whether you invest or not. The only question is whether future you will be thanking you for getting started, or wishing you had. The choice, like always with money, is entirely yours.